Hello, my name is Leonard Rivers III, and in today's presentation, I'll be discussing U.S. banking regulations. My goal today is to shed light on why banks are regulated and the common objectives of bank regulations. I'll discuss some major financial events that help shape banking regulations. I'll also briefly talk about some factors that contribute to employee fraud that distinctly violate some of these regulations. I will highlight some notable regulations and share how consumers are protected. Lastly, I'll address who's responsible for enforcing and inspecting regulatory compliance within the banking system. So, why are banks regulated? Our country's financial hardships, past and present, justify why banks are regulated. When we look at our current economic climate within and outside the banking system, it's pretty apparent that in this country, we've had our share of financial woes that we've overcome, but also continue to face, which has also become a great political conversation in terms of how we'll repair some of the damage that's been done within and outside the banking system. Banks have played a significant role in our financial hardships, taking into consideration the overextension of unaffordable loans to unqualified borrowers. Secondly, banks fail. There were many banks that failed during the Great Depression. Some of the largest banks and lending institutions failed during the Great Recession of the 2008 financial crises, and these events had a significant adverse impact on consumers, which will be discussed later in the presentation. Lastly, banks are businesses that earn profits by way of consumer deposits and loans. When a customer deposits their funds into a respective bank account, banks keep a percentage of deposits in cash reserves, and the remainder is used to lend to qualified borrowers. Banking regulations help ensure these practices are fair, comprehensive, and transparent. As mentioned earlier, there are some major financial events that have helped shape banking regulations. The Great Depression is one of the earlier notable events that served as a foundation for how banks would prepare to do business better after many banks failed and lost a lot of consumer trust after losing their money and mishandling cash reserves. One of the great byproducts of this time, however, was the establishment of the Federal Deposit Insurance Corporation, otherwise known as the FDIC, which offered insurance coverage to bank customers that would protect their assets. To participate in the FDIC, banks had to qualify because of the high failure rates at that time, and participating banks had to adhere to annual inspection to ensure cash reserves were being properly managed and liability was minimal. Prior to the federal rollout, some states were already incorporating this idea of financial insurance coverage, but even those institutions collapsed during that time. President Roosevelt's endorsement of the FDIC under the Banking Act of 1933 helped consumers rebuild trust in the banking system. We again would be able to see the impact or the important role that the FDIC actually played in 2008 during the financial and credit crisis, during the Great Recession, where again many people lost a great level of trust in the banking system due to unfair and deceptive practices executed by banks and lenders. People lost their homes because of the disguised and undisclosed terms and conditions of the loans, not afforded or not affordable to borrowers. Banks and lending institutions were shutting down and being acquired. The FDIC eventually would increase their coverage limits from $100,000 to $250,000, which gave some consumers a peace of mind, but it didn't rid the concern people would still have about banks after seeing some of the largest banks and lenders simultaneously collapse, such as Washington Mutual, Fannie Mae and Freddie Mac, Countrywide, and a host of others during this time, all primarily due to extremely poor lending practices and poor operations, some of which included, certainly not limited to, overstating borrowers' income or not verifying income sources to confirm the loan was affordable to the borrower. Loan officers would base the affordability of the loan on the equity or the value of the home, or the projected equity or the value of the home, and then would increase payments after a fixed period without full disclosure to the borrower to collect larger incentives. These unethical practices would later serve as major catalysts for many banking regulations and compliance changes that would follow. So, when we discuss the conditions many people were arguably forced in by the banks, it's inevitable to examine some of the potential factors that would lead employees or organizations to engage in such behavior. It's very clear in some of these cases greed plays a factor in this type of criminal or organizational behavior committed by the employee or the organization. Whether the motivation is a new promotion, additional notoriety, higher incentives, oftentimes organizations or employees will continue a practice, even if it's unethical, if it's something that could seemingly propel their position and is recognized or applauded in the process. Conversely, employees will also commit acts of fraud if they feel as though there is a need for it. If they feel as though their jobs are in jeopardy, they need to financially support their lifestyles, or if the behavior appears to be a part of the corporate culture. There are many organizations, including banking, that advocate a win by any means necessary culture that's intimidating to some employees who often succumb to the pressure. Finally, if an employee is dissatisfied with their employer, their position, or their compensation, there is a possibility they will engage in fraudulent behavior to act out or acknowledge the disparities within the organization. Oftentimes, moral disengagement plays a critical role for employees that commit fraud. So, with that, let's now take a look at some notable regulations to understand how banking regulations protect and safeguard consumer rights and financial assets. The Dodd-Frank Act strives to improve accountability and transparency in the banking system. It forces banks to be more upfront about fees, cost of doing business, and properly disclose terms and conditions appropriately to avoid another fallen financial marketplace filled with disgruntled consumers who fall victim to deceptive bank practices. Regulation Z, known as the Truth in Lending Act, prohibits loan originators from persuading consumers to make decisions solely based on the originator's best financial interest. The Act also prohibits loan officers from being paid based on the type of loan a consumer takes out. Instead, they are only compensated for the loan amount that has been extended to the borrower. Regulation DD, referred to as the Truth in Savings Act, allows customers to make well-informed decisions about where to deposit their money based on full bank disclosure requirements. This act also allows consumers to shop around various banks and draw a real comparison to see where they could get the best return for their deposited funds, and banks are required to reveal any penalties, restrictions, or limitations that may apply. Regulation C under the Home Mortgage Disclosure Act, sometimes known as HMDA, requires banks to forward any mortgage application taken or any mortgage that's acquired to determine if any lending patterns could be deemed discriminatory and if housing needs of communities are being properly served. Regulation B, the Equal Credit Opportunity Act, falls in line with Regulation C with regard to discrimination by making it illegal to lend to customers based on race, color, religion, national origin, sex, marital status, or age. The regulation also requires banks to be more transparent with the application process and to properly collect information from all applicants on the loan to ensure affordability and accuracy. Regulation CC, the Funds Availability Act, ensures banks are transparent with deposit holds and determines the length of time a deposited item can be held before being made available to the consumer. The proper disclosure of held deposits allow customers to make informed decisions and essentially avoid potential fees from the bank or third-party sources. Regulation E, the Electronic Funds Transfer Act, creates protection for consumers regarding electronic transactions. Millions of consumer banking transactions are conducted electronically now, so this warrants additional protection extended to consumers by way of offering refunds when appropriate for bank processing errors, as well as fraud liability claims for transactions conducted using debit cards, online banking, or wire transfers. It's conducive to discuss who enforces and monitors these regulations within the banking system to showcase the objectives of consumer protection. The Consumer Financial Protection Bureau, otherwise known as the CFPB, has played a critical role in enforcing and inspecting bank regulatory compliance processes. The CFPB was established as a part of President Obama's Wall Street Reform Act and has been dedicated to creating and enforcing extremely clear financial laws which banks are required to abide by. The CFPB accepts consumer complaints, they provide educational resources to consumers about rights they possess as banking customers, and they actively or proactively seek out any potential loopholes in current financial laws that are threatening to consumers. The Office of the Comptroller of the Currency, or the OCC, acts in more of a supervisory capacity to national banks. If a bank is found to be breaking any financial law or not following regulatory compliance standards, the OCC can remove officers and directors. They can negotiate agreements to change banking practices. They can also issue cease and desist orders as well as impose financial penalties to the organization. Bank examiners and auditors randomly and thoroughly inspect banking processes by going out in the field and engaging with personnel to ensure regulatory compliance is being followed appropriately. Examiners and auditors report and record any findings, and banks must implement immediate changes based on the feedback they've received. To illustrate the significance of these roles, it has been discovered through investigation by the CFPB that some of the country's leading banks within the last 3 years, which is really recent, have violated some consumer protection regulations. Wells Fargo Bank, for example, was recently penalized due to personnel opening unauthorized accounts and transferring funds from existing accounts without customer consent. JP Morgan Chase and Bank of America were also penalized for falsely charging monthly fees to customers for credit monitoring add-on packages that were applied to their credit cards, also without their consent. It's these types of situations and this ongoing organizational behavior that not only warrants banking regulations and agencies that enforce them, but it also justifies why consumer protection remains a top priority in the banking industry. This concludes my presentation, and I thank you for your time.